Welcome to this webinar today on Rentier infrastructure, debt, data and sovereignty in Kenya with Kevin Donovan. My name is Jethro Norman. I'm a postdoc here at DIIS, and I've been really excited for this afternoon's talk. But first, whilst today's talk looks at emerging digital infrastructures of credit and debt, I'm also aware that we're all grappling with the new digital realities of academia as in-person talks and conferences are replaced by digital formats. But I think one of the best things actually to come out of this trend towards webinars is that they're in some senses more inclusive. So interesting people from all over the world can log on and engage. And in previous webinars, we have had people from the US, from the Horn of Africa, and from elsewhere in Europe too, which is fantastic. But for me anyway, a downside is that you can sometimes feel rather disconnected, particularly when interacting solely through the computer screen. And so what we've done with previous webinars, which has worked out well, is to please introduce yourself on the webinar chat box. And that way we can generate some sense of who is actually present. And it helps to make it all a little less clinical too. So this is the latest webinar in a series on analytical approaches to infrastructure that I'm organizing here at DIIS with my colleague, Naya Kleist.
Hello, everybody. Looking forward to this afternoon.
Great, thanks Naya. And the idea behind the series is to investigate and to explore different analytical perspectives on infrastructure. And so far we've had 4 talks that have approached this topic from a variety of angles and different disciplinary foundations too. And I've actually understood the concept of infrastructure itself quite differently as well. So we began with Brian Larkin, who discussed the aesthetics and the form of infrastructure through looking at generators in urban Nigeria. Then we had Akhil Gupta, who investigated the temporalities of infrastructure through this lens of maintenance and decay. And then in the last webinar, we had Lala Khalili, who gave a very energetic account of the infrastructures of maritime capitalism. And this, I think, speaks to the diversity of different ways in which we can approach infrastructure as an analytical object and to use this concept productively in different ways as well. But I think one thread of commonality that has definitely run through all of these talks is also how we can think about infrastructures not only as political and economic objects, but also as deeply charged cultural objects too. And this, I'm sure, is also pertinent to this afternoon's talk. And so we are very grateful to have Kevin here in a digital sense, speaking again on a different topic, on debt, data, and sovereignty in Kenya. So Kevin is lecturer in African Studies and International Development at the University of Edinburgh's Centre for African Studies. He is an anthropologist and a historian of East Africa, working in the fields of economic and political anthropology, African history, and science and technology studies. Previously, Kevin has examined the technopolitics of biometric identification in South African welfare, and this grew into a larger, fascinating project on surveillance technologies in sub-Saharan Africa. And Naya and I were also personally particularly interested and keen to have Kevin involved in this webinar series because we were also interested in Kevin's earlier work on humanitarian infrastructure, which we're also looking to develop as part of our current project on diaspora humanitarianism in Somalia. But Kevin's current project, together with Emma Park, is on the cultural politics of Kenya's largest corporation, Safaricom. And it offers some fascinating insights into the entanglements between the corporate and the state. I'm sure many of us who work on or live in East Africa will be familiar with Safaricom and with M-Pesa and their various other services. And it's almost impossible to walk anywhere in Nairobi or elsewhere without encountering the kind of the symbols and the green and the red of Safaricom in some form or another. So finally, following Kevin's talk, we'll have a Q&A. There's space for you to write your questions, which is separate to the chat box. And you can do this as the talk is ongoing too. I'm told you can also like specific questions if they're particularly interesting or engaging, and that will then move them up on my screen too. So Kevin will talk for about 20 minutes, and then we'll move on to the Q&A, which is scheduled until 1:45, but for which we can go up to the hour mark with. So without further ado, Kevin, the floor is yours.
Thanks very much, Jethro. It's wonderful to be here. Thank you for the invitation and the opportunity to speak with you all. I'd like to speak today about the kind of confluence of digital data and debt in Kenya. And as Jethro mentioned, what follows comes from a book project with Emma Park of the New School for Social Research in New York City, focused on the remaking of markets and statecraft by Safaricom, which is Kenya's largest corporation. Whether it's what is understood by development to popular subversion and aspiration, the telecommunications and financial giant Safaricom today operates in neither fully public nor fully private, neither of the market nor of the government alone. Their management of infrastructure, of communications and payment, including the ubiquitous mobile money service M-Pesa, are central to this. But so is the fact that Safaricom is partly owned by the government of Kenya and a significant contributor to its finances. And so in the broader project, we conceptualize this as a parastate, a sort of lateral form of governing wealth in people, in knowledge. And today I'd like to explain how Safaricom is at the forefront of managing debt as a rentier, extracting value in ways that are distinct from market logics and simultaneously crucial to the reproduction of the Kenyan state's fiscal architecture. But perhaps the best way to start is the ethnographic. So Fuliza, he shouted at his friend, pointing to him in a good-natured way. We were a couple of drinks in at this point in June 2019 in a downtown Nairobi pub. Moments before, Victor, the target of this demand, had the temerity to suggest that he might go home, gesturing to an empty wallet. The matter seemed out of his control. Hakuna pesa, there was no money. But the demand to Fuliza suggested otherwise. Fuliza, used in this sense, is a relatively new semantic addition to Kenya. From the Swahili verb to continue, Fuliza is a brand name project from Safaricom. Unveiled at the start of 2019, Fuliza is described as an overdraft facility. If you run out of mobile money value, but you're trying to make a purchase, Fuliza will offer you an advance, charging you a daily rate until you repay. In this case, though, Fuliza, thrown across a table of bottles, was a playful command to keep the fun going. It was a demand to draw on the future to continue socializing in the present. Empty wallets be damned, there was a good time to be had, and digital debt would make it happen. Now, looking back on the episode, one of the remarkable things about this evening in June 2019 is that when our friends introduced us to this pub, it was as a site of familiarity. This is our local, they said, despite the fact that they all lived a bus ride away from this downtown location. Self-described activists, these on-again, off-again students at the University of Nairobi, spent many a night there, popping in for a drink to say hello or, spending hours discussing the politics of the day. They could leave their bags there, they told us, knowing full well that the waitress would look after them. And in fact, they told us at the start of the evening they could count on the waitress to cover their tab once in a while, paying for their drinks out of her tips and letting the unemployed guys repay them when they could scrounge together the money. So in other words, what's remarkable about this episode is that there was ostensibly no need to use Fuliza. They had other routes to continue the night. But of course, digital lending algorithms are importantly different from entrustment among friends. There are many reasons why the app might have been preferred in that moment. Perhaps they already owed the waitress. Perhaps it was better to bank her goodwill for the future. Perhaps they knew she was hard up that week. In contrast, they knew that Fuliza would lend to them, provided they were not already in default with the service. And lend it has. In the first week alone of service, Fuliza lent 1 billion Kenyan shillings. Over the course of this year, 2020, it's grown enormously, with daily average borrowing at 830 million shillings in the context of the COVID slowdown. And Fuliza is not alone. At the time of our last fieldwork in 2019, the country was host to at least 50 lending applications, some offered by Safaricom, others by Safaricom's banking partners, and still others by third-party applications. Some of the most prominent are M-Shwari and KCB M-Pesa, joint offerings of Safaricom and large banks in the country, while others like Tala and Branch are independent with their roots in Silicon Valley. And across the board, these loans tend to be short-term, usually only lasting a month with the option to roll over, and expensive. Fuliza has an interest rate of 150% if annualized, and while Mshwari's interest rate would be 90% if annualized. So these applications rely on mobile phones to harvest behavioral data from millions of users. So they sit quietly in people's pockets, analyzing their call records, their mobile money spending, and the digital lenders, through doing this, are coming to computationally know the credibility of would-be borrowers in order to modulate how much credit is offered. So who you call, for how long and how often, when you buy airtime, for how much, who sends you money, do you send money to whom, where you're located at a given point, where does your phone sleep, for instance, and how long your account has been open. These and many other variables offer a sort of granular archive, a historical archive of transactions, of behaviors, of your relations. And so for proponents of this sort of lending, it solves a problem that has hampered lending to poor people for ages. How do you assess creditworthiness in the absence of past loans and without the security of physical collateral? If you cannot lay claim to land, say, or a reliable future income, how can you secure your loan as a creditor? Digital data therefore offers the promise of financial inclusion, that curious utopian project of development through debt, entrepreneurship through obligation. This is what Keith Breckenridge has called reputational collateral, where assessments of character provide security for lenders. So for economists looking at this, it solves a sort of Hayekian knowledge problem. It gives you reliable calculation about people's future propensity to repay. So overcoming imperfect and incomplete information provides the basis for markets to clear and to expand a frontier of previously excluded populations. This has indeed bequeathed a bonanza of investment, with hundreds of millions of dollars being poured into digital lending applications, with data scientists fine-tuning machine learning to find correlations between, say, how you organize your phone book and whether or not you're good for a $10 loan. Critics, too, have bought into this vision. Call it the actuarial view. So Shoshana Zuboff, in her influential book, writes of surveillance capitalism, and she, too, sees this as a kind of problem of data. But too often, I think, such approaches follow the kind of self-serving narratives of technologists who claim to be able to use this digital data to turn uncertain futures into calculable projections. Emma and I are less convinced by this. Now, whatever the merits of the actuarial worldview, and there are some, it occludes the importance of expropriating rents in securing ongoing profitability. So in other words, it's not merely to the realm of markets and information that we should turn, but to the domain of sovereignty, where the right to legitimate extraction is just as important as the more commonly discussed right to legitimate violence. So as a struggle over value extraction, sovereignty is not merely the domain of the state, as perhaps it would be in a kind of Weberian notion of the state. Rather, if we look at sovereignty as something about extracting value, we need to think about it as distributed across states and corporations. Safaricom, we think, is so important because it's refined a means of seizing value and ensuring debt repayment that is predicated less on coercive violence, but rather on more subtle, invidious forms of mediating everyday life through the management of infrastructure. So to understand the popularity of borrowing in Kenya, digital borrowing, it's crucial to accurately account for the dynamics of the popular economy. Many Kenyans are compelled to turn to loans due to frequent experiences of illiquidity. For those who make money on the day, whether that's selling clothes or vegetables by the side of the road or working as a motorcycle taxi or Uber driver, the specter of insolvency hovers always on the horizon. Some days may be good, indeed, but others will result in no income. If income is volatile, so are exogenous shocks, ranging from medical emergencies to the need to contribute to family funerals. But there are also demands on people's wallets that are of a much more routine basis, from paying rent for housing, to food, to school fees and transport costs. Life in Nairobi and in increasing amounts of the country is commodified in a manner that places a priori demands on whatever little income might be made. This is what we think of as the zero balance economy. In reference to the kind of common shorthand for running out of airtime credit, having zero balance on your phone, the zero balance economy is this shared predicament of being unable to meet necessary expenses with ordinary income. So as a result, many are compelled to turn to loans to bridge the gap between what you have presently and what you need to pay presently, between present funds and necessary expenditures. Safaricom is exemplary of the way that corporations can capitalize on these very many liquidity crises that people are finding themselves in all the time. Safaricom is very good at making money in this sort of zero balance economy, whether it is selling airtime in very small packets that fit daily budgets, or offering airtime on credit through the Okoa Jahazi service, which I think like a third of airtime is now sold through Okoa Jahazi, or more recently by offering general purposes loans through M-Pesa, the mobile money service. All of these fit with this kind of temporal logic of the zero balance economy in which volatility and illiquidity are always on the horizon. It is their command over the communications and the payment infrastructure that allows them to expand into this frontier market. So I've explained how they're able to monitor social relations, financial transactions, personal movement, and how that gives them an archive on which to draw in converting data into debt. And their position as an obligatory passage point has compelled Kenyan banks to work with them. So beginning with the Commercial Bank of Africa in 2012, banks from KCB to Barclays have subsequently turned to Safaricom to both access their payment channels, to use M-Pesa to reach customers, but also to access the data on which to base credit scores. But command over infrastructure is not only about the prospective capacity to predict repayment, it's also about the capacity to compel repayment. So in contrast to a bank branch lending, where they need collateral property, or even microfinance with its expensive group borrowing model and roving loan officers, digital lenders have a remarkably inexpensive means of recouping their principal and interest. Many of Kenyan borrowers we spoke to are frustrated about the range of cajoling and more overt pressures from digital borrowers, or from digital lenders. Lenders rely on frequent text messages, nudging people to not only borrow, but also to repay. They use behavioral economics to encourage people to repay these expensive loans. Sometimes they go even further. A couple of lenders have scandalized the public by peering into people's phone contact lists and then calling family or bosses to report delinquency on loans. If social pressure is not enough, they turn to more blunt instruments, such as blacklisting people, more than 3 million Kenyans at this point, on credit reference bureaus, many for loans less than $10. Clearing one's name is necessary not only to apply for many jobs today in Kenya or to apply for rental housing, but it also requires repaying both the debt and paying for a certificate of good conduct from the credit bureaus. So instead of alienating physical collateral, digital lenders sort of envelop their customers within an infrastructure of monitoring, of incentivizing, and of prompting. But it isn't the case that they completely forego collateral. When M-Shwari was first designed, for instance, it froze users' savings as a form of collateral. And in the case of Fuliza, the overdraft facility with which I opened, the logic is slightly different, but all the more revealing. Fuliza debts, if you have a debt with Fuliza, are repaid by Safaricom capturing incoming mobile money value. So if our friends at that pub that night hadn't repaid Safaricom, Safaricom would simply capture any mobile money that arrived in their account. It doesn't matter what it was intended for. It could have been tuition, or it could have been for me to buy the next round. Safaricom would effectively put itself ahead of other potential uses of that money. This is collateral as mediation, as infrastructural mediation. They can create their own hierarchies of worth. And as a result, Kenyans have to find all sorts of ways to route around this seizure. Some get second SIM cards, one for Fuliza and one for all their other transactions, safe from the prying infrastructures of debt repayment. If you've been in Kenya recently, it's common enough to be told, hey, don't pay me on this phone, I have Fuliza debt. It'll simply disappear. But this is a very cramped style of negotiating the infrastructuring of the economy in favor of the lenders. Safaricom's distributed network of mediating everyday life gives it this privileged position for determining what debts are repaid, what lenders are made whole. And as a result of this exorbitant privilege, Safaricom's loans have been repaid at a rate of 94% by 2018, the latest for which I have data. This is 20% higher than companies that don't run the infrastructure. Now, in our view, Safaricom's model is best understood as a form of rent extraction. So rents are usually defined as income derived from the control or ownership of a scarce asset. This can include many things. It can include ground rent, that which you pay to the landlord. It can include licensing fees for payment to intellectual property holders, interest paid to banks for their ability to create credit, or the fees charged by monopolists. So rents stand in contrast to a view of market exchange, where competition is ostensibly the reigning logic, the reigning governing logic. And instead we look to theorists like Nancy Fraser, who point to capitalism's dependence upon confiscating capacities and resources. In the approach that Fraser has kind of synthesized, it's not merely the exploitation of waged labor which gives capitalism its dynamism and its accumulative capacities. It's also the capacity to expropriate things like the free gifts of nature, like the unwaged work of women, and also predatory loans and debt foreclosures. So today, the turbulence of the zero balance economy is subjugating workers and states to these conditions of expropriation, subjugating them to rent seeking. Structural adjustment and the development ideologies of financial inclusion have made poor people in Kenya and beyond available for such forms of racial capitalism in which it's necessary to use predatory lending. They need to buy time to get from here to there. But this facilitates the confiscation of their wealth by lenders, preeminently Safaricom and its banking partners. Now, for Nancy Fraser, this is often theorized in the realm of Atlantic slavery or South Asian bonded labor. But the logic here is not one of violent compulsion. Rather, it's the stern logic of infrastructural necessity through which rents are extracted, the need to use Safaricom. There's been considerable public dissatisfaction with digital lenders in Kenya. If you've read the paper over the past 5 years, it's impossible to miss. Our interlocutors call these digital lenders dogs. They say people have become enslaved. The media is very keen to cover the kind of personal travails of borrowers. And even the governor of the Central Bank of Kenya has eventually come around to express some regret about the permissive regulatory regime under which digital borrowing expanded. Yet it is precisely to the Kenyan state that we must look to understand why this frontier debt crisis was manufactured and with what consequences. So rents, of course, often depend upon the complicity of states that uphold private property regimes, for instance. But this is no less true in Kenya, but it's also true that the state in Kenya is dependent upon the corporation. So it goes both ways. Today in Kenya, all sorts of normatively state functions are delegated to Safaricom through philanthropic exercises. Even its basic offerings of connectivity are now seen as the public good. This is done by the corporation rather than the state. The Kenyan state turns to Safaricom for all sorts of functions, whether that is to create a national security surveillance system, or if it's this year, providing a subsidy so that ordinary people can continue to use mobile money in the context of COVID. It's all the more important for the Kenyan state to delegate to Safaricom because the state is stuck in its own form of zero balance economy. So I spoke earlier about how waged and unwaged people are confined to this kind of experience of frequent volatility and illiquidity. unable to meet their necessary expenditures with available cash. And so they turn to debt. But much the same applies for the Kenyan state at the level of the government, which has lurched in the past decade from new sovereign bonds to Chinese borrowing to IMF facilities, stuck in its own need to borrow in order to meet necessary costs. Today, Safaricom is a significant contributor to state revenues. It's one of the more reliable sources of funding, in part because the government holds 35% of the corporation's shares. Keith Breckenridge has spoken about this as double dipping into the company's enormous profits, first as shareholder and second as tax collector. Between 2010 and 2019, total taxes paid grew precipitously to 565 billion shillings, and there was another further 77 billion shillings paid in shareholder dividends. This is enormously consequential to the Kenyan state. And it is in the context of this ongoing sovereign debt stress, the fiscal shortcomings, and the threat of state insolvency. It's in this context that this translation of corporate earnings into state taxes is ever more important. Of course, taxation is perhaps the preeminent form of rent extraction, that which we deem legitimate. But it's important to understand that the fiscal reproduction of the Kenyan state is now significantly in the hands of Safaricom. And the manner in which this distributes sovereignty across government bureaucracies and corporate infrastructures. This being sovereignty in the sense of the right to seize value and govern wealth. The state's dependence upon the corporation for revenue is ultimately a dependence upon the sorts of expropriation perfected by Mshwari and by Fuliza. For many we spoke to, it also explains the accommodating stance taken by the state's regulators. Such an interdependence between private accumulation and public administration is of course common enough in capitalist states, yet its contours today are essentially without precedent in post-colonial settings. It reflects the achievement of a digital infrastructure, which is kind of a capillary extension into the pockets and pocketbooks of millions of Kenyans in ways the state could never do alone. Thanks very much.
Great. Thank you so much, Kevin, for such a fascinating and in some ways terrifying talk. I really enjoyed the opening ethnographic vignette as well. And perhaps to kick us off, I was thinking this whole time, I had a question about these infrastructures and about rentier capitalism, about thinking about it in terms of a notion that I know you've used before previously of slow violence as well, because we often, and it's nice, we often think about infrastructure in terms of space, in terms of vast highways, kind of sprawling ports and so on, but through this kind of focus on digital infrastructures, you're really also drawing out these temporal dimensions. And they're talking about the temporal disjunction between liquidity and expenditure, and that this isn't so much extraction through violent appropriation, but infrastructural necessity. And in this previous piece with Emma Park as well, I think you also draw upon this concept of slow violence as a way to understand this kind of gradual and unseen, I guess, often attritional violence.
Yeah.
And I think this is particularly pertinent in the Safaricom instance, where you have phone-based lending selling the promise to secure the future, but at the same time preying upon and maintaining the slow violence of perpetual debt and what you refer to as the zero balance economy, people living and working day to day. So you're still kind of using this concept, and in what ways do you think that the concept of infrastructure itself is actually a productive way of revealing these otherwise hidden temporalities of violence?
Yeah, thanks, John. That's really helpful. I mean, when you speak to people about Mshwari, Fuliza, these digital loans, people talk about them as fast cash, right? They very much experience them, and they're desirable precisely because they're fast, right? So the kind of iconic experience of trying to get a loan from a Kenyan bank is one of waiting in a queue. And so the attraction of digital lending was, and of M-Pesa, it should be said, first, was about the kind of immediation, right? The kind of turn to the immediacy of these, that you didn't have to interact with the loan officer, you didn't have to wait in a queue, pay for bus fare to get down to the bank branch and maybe be turned away and have your day wasted. And people see that with some ambivalence. They see the kind of manner in which Parker Shipton has, analyzed this for Western Kenya in terms of the kind of quick money and the risks of quick money. Yeah. And what we were trying to get through with Rob Nixon's notion of slow violence was this lack of certainty about when is a crisis, who determines a crisis, right? It seems to us that there was very much a kind of crisis before COVID of indebtedness, but without being kind of officially authorized or classified as a crisis, people were suffering. And it wasn't that they were suffering in perhaps calamitous ways only. They were turning instead to, after this appeal of the immediacy of digital debt, they were then turning to more long-lasting forms of debt, of entrustment, right? So people who found themselves unable to repay these digital debts and listed at the credit bureau or having their incoming mobile money seized would then turn to family, friends, coworkers for a bailout, right? And that, brings its own sorts of temporalities, both of the need for kind of historically investing in those social relations, but also of keeping them ongoing once you've had to draw on them to repay the debt. So I think people are really balancing between multiple temporalities in this.
Brilliant, thanks, Kevin. And it's also interesting, I think, thinking about this violence not only in terms of the contest over space or bodies or labor, but also over time. And I think you draw that out well. And I think, Naya, did you have a question lined up?
Yeah, thank you so much, Kevin. That was really fascinating. I was also really intrigued by the temporal dimensions and wondering if you could say something about like the timelines in this, so fast cash versus slow bank accounts, but also, so how does debt add up? When does it have to be paid, etc., and how this creates ideas of uncertainty or certain futures. Thank you.
Thanks. Sorry, and I should have been clearer about that. So these loans are often short term. The kind of standard model is 30 days, at which point you need to repay both the principal and the interest. The interest could be a fee of 7.5% after 30 days. You can roll it over usually twice to 90 days or 120 days before you're declared insolvent, and your interest rate is added each time you do that. There's an important question, and why we kind of demur from what we've called the actuarial view is if the data is as effective as the industry would suggest in terms of peering into the future and knowing the capacity to repay, then it shouldn't stop its accuracy at 30 days, right? These should be loans that are longer term while still managing to accurately reflect people's creditworthiness. The fact that it hasn't done so suggests two things. One, it suggests the importance of these companies able to access debt on a much longer time frame from international capital markets and then recycle it into short-term loans so that they're able to capture the difference between the interest rates every month. And it also suggests the kind of lack of popular involvement because people want longer-term credit, and their pleas in that way haven't been heard, and the industry hasn't really moved despite this notion of a lot of competition. We haven't seen a lot of changes in the kind of market and the offerings there.
Great, so we've got a couple of questions rolling in now, and a great question actually from Freddie Carver, which is definitely of interest to mine and Naya's work as well. And he's asking about whether you think this domestic system of rent extraction interacts with international financial flows, particularly remittances. And how do remittances compare as a form of credit? How successful basically have Safaricom been at integrating these flows into their rent producing system?
Yeah, it's a good question, and one which I would, I'll have to admit to not knowing much about the kind of remittance architecture of Kenya. One thing that does come to mind is the manner in which Safaricom has dragged its feet or been unwilling to kind of mediate international remittance flows. They've grown so much on the back of domestic remittances, for which was the kind of emblematic first use of M-Pesa. But they have blocked people trying to use M-Pesa for international remittances. Famously, they blocked BitPesa, which was trying to do this through blockchain or Bitcoin, and was trying to use M-Pesa as the kind of final mile. And why they've done so, I actually don't have a good answer, but it does fit with a kind of broader sense of the corporation as particularly focused on the nation, despite the fact that it's 30% or so held by Vodacom and UK Vodafone. So I don't have a great answer to that, but I'd be really curious to what you find in the DIIS project along those lines.
Great. Hopefully that's something we can explore as well, and kind of link to that as well, or link to this idea of intersections between particularly the humanitarian and the development sectors. Aaron Martin is now asking, are the humanitarian and development sectors increasingly turning to cash-based interventions, including through the use of mobile money? Or they are. But are there documented cases of cash aid meant for beneficiaries being diverted by mobile money platforms to pay off existing debt, which could potentially be a dereliction of humanitarian values?
Yeah. I don't know of those cases. I would be shocked if they hadn't occurred, given the predominance of Fuliza debt in particular, which is the mechanism that most readily reappropriates or redirects incoming value. So if Kenyan humanitarian beneficiaries in Kenya were receiving cash transfers through M-Pesa and had Fuliza debt, it would go to Fuliza unless there was a particular kind of dispensation offered. I know the corporation is anxious about this, and that there were early signs that people were turning away from M-Pesa, which is enormously profitable before COVID for the company, and that there might be changes to how that kind of repayment enforcement that I described today unfolds, but that hasn't happened so far. So I think almost certainly some of that money is being redirected.
Right, so something to watch for the future for sure. And Marie Colling, also from DIIS, was asking if you could talk a little bit more about reputational collateral, or this idea of reputational collateral. Is this more than just people's reputations at stake? And secondly, whether you could also say something about the proliferation of debt among the poor population in Kenya. Is this predominantly an urban issue, or is this something that's happening across the whole country? How is this kind of spread out geographically?
Yeah. So Keith has a paper in African Studies where he tracks the kind of effort to create a property-based collateral regime in Kenya and how that doesn't happen. And Safaricom is able to create a data-based collateral regime. And what he's trying to point to is the manner in which these digital traces are understood to be kind of assessments of character, right? Not unlike credit scoring in other contexts. I think for many Kenyans, though, there's a significant disconnect between what is data-based and what they understand to be their character, and what other people understand to be, their peers' character, and that there's a sense in which there is a kind of ineffability and non-translatability of one's character into these databases, and so that if it is a view of one's self that's housed in Safaricom or the Credit Reference Bureau, it's a very partial view, and I think many people would find that it would be a view that only captures their worst qualities. There was a sense that many people rushed into this without fully understanding what it meant to be housed or what it meant to borrow digitally. Can you say something about the proliferation of debt among poor populations, mainly an urban problem? So we did research kind of around Mount Kenya on this. It's certainly something that statistically is higher among young men, urban populations, but in Meru, in the outskirts of Meru as well, this was common enough. And I think we would find it to track pretty broadly across all of Kenya. It would be perhaps a more urban problem even 15 years ago, where the kind of commodification of everyday life was more of an urban experience. But in places that were agrarian 15, 20 years ago, now much of life is experienced as a kind of need to buy time, to buy rentals, to buy food, and no longer a kind of subsistence economy.
Great. Thanks, and I'm bombarding you now with these questions. They're coming in thick and fast, so it's obviously struck some chords to talk. We've talked about the kind of intersections with the humanitarian and the development sectors. And there's a question here on how it might intersect also with fintech. So Sarah Sadiq asks, as you briefly mentioned, access to credit is particularly interesting for women in emerging markets who are more likely to be employed outside of the formal sector. And so fintech is often described as a key enabler, not only for economic growth, sustainable development and financial inclusion, but also for women's empowerment in terms of bridging this kind of gender gap. Do you see any gender specific issues when it comes to the infrastructure of lending or this idea of perpetual debt?
Yeah. So at least in the early years of M-Shwari, the kind of breakout digital lending service that started in 2012, the most common time to borrow was 4 a.m. And that was representing women going to the market and buying stock for the day. And it was serving as kind of working capital. And oftentimes, they were repaying it. They were repaying it at a 7.5% fee. This is enormously expensive credit. So, it's another burden placed upon women. And while, the industry is quite keen to see this as kind of women's empowerment, and no doubt some people experience it as empowerment. Credit is important, right? Credit is both in its financial sense and its more abstract sense. But we should imagine different ways to provide this credit, different ways to kind of assess the digital traces people are leaving, and different ways to encourage repayment. These could be done on the kind of model of a SACCO, which is perhaps the most common financial instrument in Kenya, where people come together under some sort of organizational umbrella or not, or just in a kind of peer-to-peer model, and provide credit to each other in a rotating or needs-based moment in ways that are flexible, allow for kind of changes to repayment schedules, longer terms. But the industry, is very much done it in a more short-term, extractive way that has filled a niche, but not in a way that I think we can see quite substantial quantitative empowerment. So that the best study of this by economists, found a very small change in resilience to exogenous shocks. They didn't find more substantive poverty alleviation. Any name your kind of development indicator. And I think this is indicative of the manner in which this has been marshaled as a profiting market, rather than one that has been designed with the needs of market women at the fore.
Yeah, thanks. So we've got a couple of questions that I'll sort of group together as well, that are sort of coalescing around this idea of what this type of rentier infrastructure means for the state and for development in general, and how these mobile money lenders are accountable to international investors, or the responsibilities of international investors. So I was wondering, perhaps you could speak a little bit more about the implications of this for the state and the entanglements that you're talking about between the corporation and the state.
So is this in the Q&A? I'm just trying to...
Yeah.
Is this Clara?
So I've got Abdul Kadir and Clara, and also Wangui. Clara is also talking about tax evasion. I'm wondering if you counted any traces of China having aided in the building of this digital infrastructure.
So Emma's working on another book which traces the history of Kenya back into the 19th century. And the corporation was there at the founding. This was the Imperial British East African Company. And so this kind of relationship between the state and the corporation has a much longer history. And I think it is only a kind of artifact of our kind of common sense rather than good sense that we think of the corporation and the state as so distinct. And so actually putting these together isn't novel, but it's perhaps exacerbated in Kenya today. Why is it important to see these? Well, for one, the corporation as a means of governing wealth, but redirecting wealth in some cases to the state, redirecting wealth in other cases to shareholders in London, is also a way of avoiding public accountability, right? And so, for whatever the kind of democratic deficits of the Kenyan state, Safaricom doesn't even have to, pretend to be democratic or accountable to publics. It has a very different purpose, as understood as legitimate by most people. So this sort of delegation or shell game between them, which is different in education, it's different in lending, it's different in kind of the notions of citizenship that both entities marshal, really needs to be tracked very closely, I think, and I think it has something to teach us about state-owned enterprises in China, the Bank of England in this country, and the ways in which wealth is managed kind of slightly outside the state. To the specific question about China, not as the kind of specter that that often is raised as Huawei builds this infrastructure. Safaricom is a very reliable Huawei client or customer. But my understanding, other than the kind of surveillance system, which is a different beast, these are kind of white label, off-the-shelf technologies. They're not that sophisticated.
Great, thanks. And we're over time, but we can continue going for at least another sort of 5 or 10 minutes whilst we've got some questions, if that's okay with everyone. And Christine is asking an interesting question actually about whether these new forms of lending lead to new forms of consumption. So perhaps betting and gambling or other forms of consumption. Is there any indication of that?
Yeah, as kind of as moral panics, sports betting on the phone and mobile borrowing have emerged at the same time. They are linked in some ways, but the evidence on whether or not the loans were going towards sport betting is mixed, and I think it's probably overstated. I think far less scandalous forms of consumption, food, rent, transport, medical fees, are far more important to where digital debt is being spent. But there's no doubt that the phone as a kind of financial infrastructure has enabled things like sports betting to take off as well at the same time.
Interesting. And to sort of kind of go back to what you were talking about, you mentioned surveillance as well. As I was thinking, as you were talking, that this entanglement between corporation and state nicely sort of counters this narrative of neoliberalism eroding the power and role of the state. There's also this piece out yesterday by Nick Cheeseman titled How Western Companies Undermine African Democracy. And he wasn't talking about arms dealers or Cambridge Analytica, but about predominantly internet and telecommunications networks, and specifically Vodacom and their role in the recent Tanzanian elections as a kind of conduit for alleged electoral malpractice. And I know some of your previous work has also focused on surveillance. So as far as the mining and processing of data becomes a kind of key form of corporate rentierism, is there any indication for what happens with this data that Safaricom kind of privately or gathers? In other words, what is this kind of relationship between accumulation of this data and state surveillance?
Yeah. So Kenya passed, I guess at the end of last year, a Data Protection Act, which was eagerly sought by kind of technology policy folks who pay attention to it, modeled on the GDPR in the EU. I'm much less optimistic about the capacity of this to rein in, what Zuboff calls surveillance capitalism. I think actually what we find is that these clear regulatory landscapes actually allow large actors like Safaricom to pursue the commodification of datas and of selves, of time, in ways that fit their interests. The kind of notion of individual consent is completely inadequate to the kind of collective power that's necessary to rebuff these sorts of industries, and yet these data protection acts are very much at their core concerned with informed or express consent on the basis of the individual. And so I think, much more we need to think about transforming credit into something that is collectively managed rather than privately managed. And we should think about removing data from the realm of digital data from the realm of kind of commodities, which will flow to places like Safaricom, which can access cheap credit to afford building the infrastructures and buying up the data. And instead, we need to think about democratizing finance so that it is actually collectively, determine what timelines and on what costs and to whom we are providing the means to draw on future income in the present, which is what a loan does.
Yeah, great. Chia writes, thank you for the inspiring presentation. I'm wondering, would you consider digital surveillance-based lending and the zero balance economy being less exploitative if the interest rate can be more reasonable? So can the concept of corporate social responsibility save this?
Perhaps. I would, the fact that the interest rate is so high is a large part of this. I am less confident that a kind of notion of 2 or 3 bottom lines for a corporation are going to change this. The investors so the kind of venture capitalists who invest in a company like Tala or Branch have an expected rate of return that won't allow the kind of CSR. Instead, what's happened through the kind of notion of financial inclusion and associated trends in the past 20 years in the development industry is to transform commercial offerings into something that is already philanthropic. So it doesn't actually need to change. So, for instance, the UN has been very keen to see the access to the internet as a human right. Okay, perhaps, but as long as we're not thinking about the business model on which the internet is offered, we're not actually thinking about this kind of tension between public good and private good. We're instead just rebranding private gain as the public good, and that's very much what's happened in the digital financial services sector as well. So lower interest rates would be great. I think the means to do that will be different organizational models, which will be non-corporate. There'll be cooperatives, financial cooperatives, which Kenya has a long history of managing.
Great, and we'll wrap up soon after there's an interesting question on from Abdul Qadir on who is the typical borrower. There is an increasing middle class in Kenya. But how often does the credit tick into the phones of the lower kind of working class? So have you done any research into what different groups spend their money on and who's most affected?
There is very good research on this, in part by an organization called Financial Sector Deepening Kenya, and in part by an organization called Microsave, which is quite, admirably interested in the ethnographic, the popular economy, how people are spending. I think what's important about these loans and what's important about, or what we hope to do with the notion of the zero balance economy, in contrast to something like the informal economy, which I don't find a very compelling notion, is to note the manner in which there's a shared predicament for both the waged and the unwaged in Kenya, both citizens and the state. So, my middle class Kenyan friends who have a private vehicle that they drive until, the third quarter of the month when they start to run out of salary from the previous month, or, who work in the NGO sector, they also are part of the kind of zero balance economy, and they also turn to these in ways that are far more similar, or are quite similar to those that we think of as part of the informal market, or, the very poor. And so I think it's important to not a priori separate these categories and instead look how people are in a context of high inflation, enforced austerity, suppressed wages, in which people are similarly situated. And the kind of trick of debt is that it's shameful in many cases, and it individualizes us, and it prohibits us from seeing our shared predicament in ways that I think are quite lamentable.
An interesting.
Before you off, Jethro, I just thought Grace Gatow has a comment about how
Sure.
University students are hooked on these loans, and then the burden is placed on the parents. And I think it's a really important point, the way in which these individualized debts end up animating social relations or burdening social relations, whether those are university students having to turn to their parents or friends having to turn to each other because they thought they were entering into this kind of individual borrowing market. These are actually, at the end of the day, socialized debts, but not in ways that I think we have a full accounting for.
That's great. Thanks, Kevin. And I get one thing that I've been constantly thinking of as well throughout this, perhaps which we can kind of wrap up on, is a question actually about the basic algorithms that track these everyday behavior and social relations, and then issue the loans and the credit based off them. So, and I know algorithmic bias and the idea of data discrimination has been a hot topic recently with algorithms of repression and so on. But how much do we actually know about how these algorithms work and the criteria they use by which to analyze data?
Yeah. So the conversations I've had with kind of data scientists who have been involved in this, they do analyze tens of thousands of huge amounts of variables, but a number of them have told me that the variables that actually determine creditworthiness are quite few, and they're essentially proxies for wealth. So it's are you borrowing on an iPhone? Do you live in this neighborhood versus that neighborhood? And did you repay your prior loans? And so they didn't know that beforehand. They didn't run these kind of machine learning things that are far beyond my expertise to see what the final variables were. But at the end of the day, they're not that surprising, and they're certainly, they're not as egalitarian, as we might hope. And so that is not to say that they haven't been able to lend to poor people. It's to say that they've had to refine, given the volatility of poor people's incomes, they've had to refine their means of compelling repayment, as well as their means of kind of prognosticating.
Amazing, thanks. I think regrettably, due to time constraints, we will probably have to end the discussion there. But thank you so much, Kevin, for such an eye-opening talk, and thank you to everyone who's attended too. A gentle reminder that you can access all of these talks online via the DIIS webpage as well. But for now, thanks once again, Kevin, and I hope everyone enjoys the rest of the day.